Well, hello, everybody, and thank you for joining us for our quarterly update on REIT performance. We're going to be talking about public real estate, property types, trends, artificial intelligence, and really an awful lot of things that you would like to talk about as well, because we will be taking your questions as we always do. My name is Mike Consol, and I'm editor of Real Assets Advisor magazine, one of six titles published by Institutional Real Estate Incorporated, which is co-producing this event along with Nareit, the National Association of Real Estate Investment Trusts. Nareit is represented, as it is every quarter, by John Worth, Executive Vice President of Research and Investor Outreach for the organization. Also joining as our guest for this discussion is Kristin Kuney. She is Managing Director and Co-Head of Liquid Real Assets at Goldman Sachs Asset Management. Now, to our audience members, first of all, again, thank you for joining us. We invite your questions in writing. We will get to those questions and answer them as much as possible in real time. Please include your name. I will not use your name, but that does allow for our panelists to be able to reach out to you. If we don't get to your question, they could reach out to you and go ahead and get in touch and give you the answer that you're seeking. Also, a recording of this webinar and the slides that you will see will be sent to all who registered for the webinar, and it will also be published. So the webinar in its entirety will be published on both the IREI, as in Institutional Real Estate Incorporated, and Real Assets Advisor websites. John Worth and Kristin Kuney, welcome to both of you.
Thanks, Mike. Great to be back for another quarter.
Hi, Mike. Thanks for having me. I appreciate it.
You bet. We are awaiting with bated breath what you have to say, the both of you have to say. John, you know the drill. We always begin with a review of quarterly REIT performance. In this case, REIT performance during Q1 2025. What say you, Mr. Worth?
Yeah, lots to talk about Q1 2025, and frankly, Q2 has been pretty exciting on its own for the first week and a half, and especially over the last three trading days, or 3.5 trading days, I guess now. And so first, I'm showing just equity REIT performance. This is the FTSE Nareit All Equity REIT Index. This is sort of our broadest measure of U.S. REIT performance. And as you can see, we've had a little bit of a seesaw over the last few years in terms of REIT performance. And you can see 2025 Q1 had good performance. We were up 2.8%. That was reflecting, a modest January with REITs up about 1%, a really strong February where REITs went up 4.2%. And then a bit of a retrenchment in March where REITs fell about 2.4% as they started reflecting some of the concerns about rising recessionary risks, the fall in consumer sentiment, and some concerns about the fiscal outlook and what that was going to mean for long-term interest rates and inflation. And then we've added 2025 Q2 just obviously through yesterday, which has been a real shock to the system. REITs down 9.6%. Now I should note that in Q1 REITs meaningfully outperformed broader equities, beating the S&P 500 by about 700 basis points. The S&P 500 was down about 13. Was down about 6.5% for the first quarter. And that outperformance has actually continued through the market volatility we've seen, after last Wednesday evening's announcement of broad-based tariffs against virtually every country that the U.S. trades with. So REITs have reflected that, and broader equities have reflected that. REITs are still meaningfully outperforming broader equities. REITs are down about 7.1%. As of today's open, the S&P 500 was down about 13.7% through that same period. If we take a look at sector performance, and here on the left-hand side, we've got the sector performance through Q1. As you can see, again, good quarter for REITs, up 2.8%. Best performers were telecommunications, up more than 16%, healthcare up nearly 14%, gaming up 11.5%, really were kind of the standouts. Industrial showing a bounce back after weak performance in 2024. When we look at the lagging sectors, we see it was lodging and resorts, and then data centers, which I know we'll get into sort of why after 2 really strong years of returns we would see some retrenchment in data centers. When we look at what's happened so far in Q2, again just a week and a half in, and all of this really over the last couple of trading sessions, we've seen REITs really repricing in significantly higher recession risks as a result of perhaps broad-based tariffs. Obviously a lot of uncertainty as to whether tariffs will come into place or in what form, but we could see across the board REIT retrenchment, with the most resilient sectors really being telecommunications and data centers, with gaming following up, and then the hardest hit industrial, timberland, and lodging. And so on a year-to-date basis, right now we've really just got a couple sectors, including telecommunications and healthcare, in positive numbers on a year-to-date basis as of close yesterday. But of course, we expect a lot more to come in terms of both news about tariffs and how that impacts through to the REIT space over the coming perhaps hours, days, weeks, and months. So I'll stop there, and we can open it up and discuss.
Yeah. Hey, John, data centers are supposed to be basically a bulletproof sector there. That's the property type people are pouring money into. It's bulletproof. There's no end in sight. Not looking that way in Q1 though. And then on the flip side, telecom or cell towers uh, performing well, and which is a reversal from Q1 of 2024, a year ago. What's the story there?
Yeah, and I think the data centers, down as of the end of March, down about 15%. Today, down about 21%. I actually think that is very much a recalibration as opposed to maybe a retrenchment. It's important to keep in mind data centers were one of the best performing property sectors in 2023 and 2024. With returns of over 25% both those years. Uh, and I think that there was a lot of speculation about how much demand creation is going to be driven by AI technologies. The deep think announcement, in the middle of the quarter, really, I think gave some people pause about, is this going to be a gigantic wave or just a huge wave? Because the secular tailwinds are definitely there and were there even before AI in terms of the broad-based digitization of the economy, the digitization of our lifestyles. I think there's a little bit of a rethinking of exactly how much data center space sort of AI technologies are going to need, how much of demand that's going to drive. That's resulted in some repricing of data centers. And I think whenever you've got a sector where demand for space is driven by a lot of, frankly, speculative technologies in the form of AI, even though the current tenant base is very much tried and true technologies in terms of U.S. data center REITs. That is going to move around their valuations a bit. In terms of telecom, again, yeah, kind of almost worst to first in terms of their performance. Really, I think that is it's in some ways been a little bit of a long time coming. Analysts have been really waiting for some signals that we were going to see more, sort of mobile telecom demand for space as they kind of finished the rollout of 5G, saw some new technologies rolling out that didn't get realized in 2023. It didn't get realized in 2024. There's a view now that that really is going to come in 2025.
Mhm. So, Kristin, obviously, one of the things that has been driving data centers other than video games like SimCity and so on, is
My son.
artificial intelligence, right? It's been all the rage. I don't know if anybody who's got kids knows that video games must be helping drive data centers. But AI has been all the rage, and it's advanced rapidly. It's become very public. Uh,
Mhm.
Now, when it comes to AI in real estate, clearly data centers plays a big role there. But are there other areas of real estate or the real asset space that are poised to benefit or be negatively affected by AI during the longer term?
Sure. Thanks, Mike. And I will just add on to John's points about the Q1 performance of data centers versus cell phone towers. I think we agree on everything. And it comes down to really positioning. So if you think about last year and the last really 2 years, I think everyone was pretty much long data centers, and that sentiment probably just got a little bit too heated in terms of valuation. And then you had the DeepSeek news, you had Microsoft come out, and speculation that they're going to be pulling back on some of their data center expansion plans. So that confluence of events just hurt the data center narrative, even though the fundamentals probably haven't changed at all, but the sentiment probably got a bit ahead of itself. From a cell phone tower perspective, it was exactly the opposite. As John said, everyone was very concerned about the telecom carriers pulling back on their 5G investments. So those telephone towers were actually hurt by that negative sentiment, or we've seen that reversal year to date. I think people have appreciated the defensiveness of the cell phone towers, especially in this time of uncertainty, which will actually help them also. In terms of AI beneficiaries, I would actually think that cell phone towers are actually within that bucket too. If you think about just the applications and the functions we will be able to use on AI as consumers utilize them more so on their wireless devices, that's more mobile data traffic will go over the networks. Over time, the telecom carriers will have to invest more into their networks to maintain low latency. You really want that speed of information that will come from AI to really utilize it appropriately. That will just translate to higher revenues for the tower companies also. And secondly, within the real asset space, we think obviously power demand is going through the roof with AI. So if you look at the demand estimates over the next number of years, we need about 70% increase in grid CapEx, so our utility grid investments, to go up to meet the demand needs that AI and other electrification is happening across our electricity networks. This is a benefit directly to our utilities. So think about just the owners of the telecom tower, or not the power towers and the transmission systems. All that power will have to flow through their networks and their assets. That will lead to increased investment opportunities for the utilities, which will hopefully increase their overall longer term EPS growth.
All right, we already have questions coming in from our audience members, one of which says, why do you think that residential has been hit so hard since 4/2? John, you want to start with that one?
Well, I think that when we look at when we look at the returns, they really have been the pain has been pretty broad based. So so we can see residential's down about 11%. The broader REIT index over that period was down 9.6%. I do think, if you think that you're gonna have tariff induced economic slowdown or recession, and we were already, I think, in mid-March and late March, we were already getting reads on consumer sentiment that were at 10 and 12-year lows, as I think people were just sort of feeling a lot of anxiety, even though we've been posting pretty good macro fundamentals in terms of job growth has been fine, the unemployment rate has been fine, everything's sort of been fine as measured, but this idea of a vibe session sort of, I think, took hold. I would say that is probably even more deeply rooted today than it was a week ago. And so, that is going to flow into people's desire to, stake out on their own, sign a lease for an apartment, move into a single family rental. So you definitely would see that in residential being a little more macro influenced than some of the other sectors.
Mm-hmm. Mm-hmm.
And Mike, I would just add to that, there's obviously been concern in the residential, especially the apartment market within DC with DOGE and the potential impacts on a longer over the next 12 months in terms of kind of what happens with the job market in DC with the federal government potentially shrinking.
As long as we're in DC right now, Kristin, let's talk about tariffs. The goal is to bring back manufacturing jobs in the United States. We've actually seen some of this happen over the years pre-tariffs,
Correct. Mhm.
with you know bringing manufacturing back, not actually creating that many jobs because so much automation is being applied these days. But the goal is bring manufacturing back. A lot of worries about increases, well, inflation, including materials for construction and all. How do you see this evolving short term and then maybe in the longer term, assuming that the tariffs last that long?
Sure. I think, Mike, as we've seen in the markets over the last week, there's a lot of uncertainty. And I think that uncertainty is borne out because it's probably not possible to bring back jobs in a meaningful way in a short order just by slapping tariffs on a lot of different countries. A lot of the supply chains are embedded, very difficult to move those plants quickly to other locations and not have a disruption in the supply chain, which will likely lead to inflation. So I think near term is a lot of uncertainty that people are kind of not going to make big moves and big announcements on that. You've seen a couple. And to your point, we've actually seen a number of announcements of manufacturing coming to the US pre the administration. So back in 2022, when we had CHIPS Act under President Biden, we saw a number of companies moving manufacturing plants to the US. So an example, Apple started a plant in Houston. Honda was in Louisiana. And we had obviously TSMC was in Arizona and they announced a second plant. So we've already seen a number of companies make investments in the US and commit to the US. On a longer term basis for real estate and real assets, having more jobs locally in the US is a good thing. So think about like real assets and real estate being very localized businesses, and real assets being assets that make an economy to function. Having those individuals and those plants in the US creates demand for a number of different sectors within real estate. Think about demand for industrial to house the products being built in the manufacturing. Think about more residential needed to house those individuals that are actually in the new plants. Retail to support overall more economic growth within those metros. So there's a number of positive factors for real estate and real assets. If more jobs come back to the US, I just think it's going to be a little bit longer to actually have that kind of flow through properly.
Mm-hmm. Hey, John, let's stick with oh, go ahead, John. Did you want
Well,
to?
I was just going to add, I think, one of the things we're seeing playing out basically on the, the front of the business section and Twitter every day is this question, is this a policy for permanently higher tariffs, or is this a policy to negotiate lower tariffs more broadly, sort of reducing both tariff and non-tariff restraints on trade, for the U.S. and globally. And I think as I kind of read the papers, we've got an administration that's somewhat divided, and I think some of the uplift we're seeing in markets today, I think, is a little bit of some commentary from the president suggesting he's open to negotiation. That's certainly what the Treasury Secretary has been implying. Other members of the administration are saying no. This is really to have less trade overall, more domestic manufacturing. So I spent a lot of years studying economics, so I'd be, they'll take my license away if I don't say, ultimately that makes us less wealthy, and more of our production maybe in the U.S. we may have less production and less consumption overall. So it's definitely a double-edged sword in terms of what it means for total aggregate demand.
Yeah. John, let's stick with the Beltway for one more question. And to our attendees, be patient. I see questions here. I'll get to you in just a minute, but want to stick with the Beltway with John here. In addition to tariffs, the White House is involved in a proposed tax cut bill, and DOGE, the Department of Government Efficiency. What is the view from Washington, D.C. with regard to these issues in terms of what they might mean to publicly traded REITs?
Yeah, and I'll take the tax cuts first. I think that in 2017, there was a large tax bill. REITs fared really quite well in that they were included along with other types of real estate in the 199A provision. And so the shorthand of that was for a taxable REIT investor, it really reduced the tax burden on their dividend by about 20%. And then plus lowering some individual tax rates across the board. So it's really quite beneficial for after-tax returns to REIT and broadly real estate investors. And so as we, our view is that it's going to be a long process in terms of the extension of the 2017 tax reforms and tax cuts. I think that we'll see a lot of we'll go through a lot of peaks and valleys on our way there. Our emphasis at Nareit is really communicating with policymakers on Capitol Hill and the executive branch, and it's worth noting REITs have really enjoyed strong bipartisan support for over 60 years now. And we've fared well through Republican leadership, through Democratic leadership, both in the executive branch and in the House and Senate. A lot of what we do is really educate policymakers about why it's important to have REITs as part of our investment landscape, how that helps 170 million Americans get access to commercial real estate in their retirement accounts, how institutional investors are using REITs, and ultimately, one of the things that the principles that we really strive for is equality of tax treatment. We don't try to go out and ask for something special for REITs. We just want all real estate, irrespective of form of ownership, to really have the same tax burden on a dollar of rent through to investors, and that's been a successful strategy so far, and that's what we're continuing to educate and talk to policymakers about. I will say that we're in the early innings. It's going to be a long process, I think. But so far we feel good about the broad-based support we see for REITs.
Yeah. So, Kristin, I want to give you this question from one of our audience members. What is needed for a recovery in the office sector? And let me amend that question just slightly. Are we seeing a recovery already in office, and will it ever be restored to what it was? And what's it going to take to do that?
Sure.
Not an easy question, but we know you're up to it, Kristin.
Thanks, Mike, and thank you for the question. We have seen a recovery in office. If you look at just the kind of activity across the board and across the major metros in terms of leasing activity, it is definitely off from the bottom levels and 2021 to 22. That is a function of both return to office mandates, and then companies just having to understand that they need to make longer term decisions. So for a couple of years there, everyone was kind of kicking the can down the road, as we call it. So taking on short-term renewals, not kind of understanding what their longer term space needs would be, given the hybrid working environment that everyone was in. I think employers have realized and have pushed their employees to come back to work, understand that that's kind of the best way to kind of collaborate and work together. So as we've seen return to office mandates enforced, we have seen leasing activity across the metros increase as companies have said, all right, I actually need to make longer term decisions. And maybe I do need a little bit more space, or I'm good in the space that I have, but I need some swing space here. So we have seen a number of markets accelerate in terms of leasing activity. Taking Metro New York City was probably the first one that kind of come back. And again, if you look across cities, you can't look at the overall vacancy levels because they are very masked between what's happening on the underlying basis. So really the best assets within the markets with the best sponsors are seeing the most activity. They're getting market share hand over fist over some of the older buildings which don't have amenities. So that top tier of the market, that class A part of the market, is actually doing pretty well across most metros and gaining share, and actually in some instances seeing rent growth. So we have to kind of understand the complexion of each market, because the overall stats of the overall metro probably do not tell you what's really happening under the hood. Longer term, we think that we probably won't go back to where we were pre-COVID levels. I think the question is what happens to that level of B and C office stock, which is kind of obsolescence. How do we kind of shed that space for our metros? You've seen some policies in place, but in New York City, as an example, for a tax abatement to convert some of the older office buildings to residential. Obviously, we have a housing shortage across most of the major metros and in the U.S. overall. So kind of taking that class B and class C office stock out of the market, which will probably never lease up, and convert it to a better use in terms of residential would be a good thing. But we need tax legislation really to kind of get that moving, because it doesn't make economic sense in most regards to do so for a landlord to do it on their own without some tax incentives.
Mike, just one thing to add, and I think, in Washington, D.C., we have, there's a lot of office space. The market's really been struggling, But just to give you an example of that divide by quality, even though there's a lot of office space, vacant office space for rent in DC, we're actually seeing a REIT breaking ground on new office because that's what the market is demanding. They've got, large tenants who are willing to sign long-term contracts for brand new, well amenitized, well located space. They don't want what's available in the market sitting vacant, ready to go today because it's not the quality that they desire.
Hmm. Another question, John. We have an audience member saying, how do we play the cell tower market? It was down before, now it's up. What would you advise in terms of how to play that market?
Well, I could say, what we're definitely seeing is that when we look at where active managers are moving their portfolios, they have really become they're sort of long cell phone towers. They're actually holding towers above their market weight today. And I personally have always been very bullish on this sector. I just feel like it's got, and I'm not I'm not trading every day, right? But it's got the pieces that I think you want to see in a property sector in terms of, the secular demand tailwinds pushing along demand. And there are some constraints on supply. You see that in metropolitan areas and suburbs. People sort of say, it's getting a little harder to site and build towers. So if you can, if you've got a portfolio in hand, which certainly the tower REITs do, they really sort of own somewhere on the order of 75% of the towers in the U.S. That's a great position to be in as you see that demand ticking up again.
Mm-hmm.
Yeah, John, I would think that actually we think our estimates are about 90% of the towers, the three big companies in the public side own the US towers in the US. So you really can't access those trends from a cell phone tower perspective in the private market. So it's really just those three individual companies in the public market that own the vast majority of the US towers.
Kristin, we have another audience question having to do with hotels. Now, here's another property type that just got slammed during COVID, but
Yes.
came roaring back because people were just really pining to travel. The question is, though, what is the outlook for existing hotels, operating results and acquisitions, as well as new construction of hotels? What do you see for that property type?
Sure. I would take the last piece first in terms of supply. As we've seen across most property types in real estate, supply has really fallen off a cliff. So lodging is in the same regard. There's very little new supply coming on for hotels. Obviously, hotels are the most economically sensitive sector within real estate, given it only has a one night lease term essentially. So they were priced pretty quickly in terms of demand trends. So I think we're a little bit more concerned about the consumer overall, not just us, but obviously the market is more concerned about consumer discretionary spending. What happens to business travel? Does business investment pull back given the uncertainty, and how long this kind of lasts in terms of the tariff, and what will be the overall price shock to consumers? So that's a little bit of both. The edge of like demand would probably be a little bit lower. Supply is actually an offset because there's a little less supply coming to market. So overall, I'd say we're a little bit more sanguine on hotels given versus even last week, even though the stocks are down a lot. From a transaction perspective, these typically are bigger assets. So I actually think just in terms of size and dollars put out. So I think transaction markets, especially for hotels and bigger assets in general, will be on pause until we kind of have more clarity in terms of what is happening on the rate market, which continues to move pretty quickly also.
John, here's a good one for you. Do you think private real estate is more attractive than REITs now, given the cap rate is lower relative to that of the public REITs?
Yeah, quite the contrary. Typically, you're looking for the higher cap rate investment, especially if the fundamentals are the same. And we've spent a lot of time tracking what we call kind of the public-private divergence over the last over the last couple of years, and we really saw cap rates diverge, early in 2022 as the 10-year Treasury started rising, as the Fed kind of entered into this monetary policy adjustment period, and we saw the 10-year Treasury rise 250, 300 basis points over the course of a year. And one of the things we saw was that REITs really we saw that reflected in REIT valuations almost immediately. So we saw REIT cap rates rise from about 4.5 up to over 6%. And while private cap rates, as measured by Odyssey, really stayed unchanged over that period, even as the 10-year Treasury rose, to the point where we actually had Odyssey cap rates actually at one point below the 10-year Treasury. So kind of almost a fundamental mismatch between valuation there, and that's just sort of the that's really part of having REITs being forward-looking, priced in equities markets, versus private real estate, really kind of on a slower moving valuation process as they go through the valuation process outside of public markets. So we've seen slowly that cap rate gap close over the last couple of years, but it has certainly widened out a bit in the fourth quarter. We expect that it has widened out even more, probably 20 basis points or so over the last couple of days. So as of the year end, we saw REITs trading at cap rates over 100 basis points above private real estate, while having operating performance that was the same or better, certainly as measured by occupancy rates. So we think there's a lot of bargains still in the REIT space, and those cap rate differentials, that's one of the reasons we really feel like institutional investors, they need to have both these tools in their portfolio, right? They need to be able to play on both sides of that market, because you can't arbitrage these valuation differences if you're not in the market.
So, Kristin, question about construction costs. We already see, I mean, I've always made the argument that we really haven't completely recovered from COVID-19. It just seems that supply lines aren't quite back to their old self. Now we're talking about there's been inflation. Now we're talking about tariffs, maybe goosing inflation even more. What about construction costs in terms of getting, in this question from our audience members specific to the residential segment, and whether what kind of impact is that going to have on future development?
I guess, Mike, to your point about where we are in the cycle, I think this is that's one of the silver linings in real estate today, is we did not kind of go into this if we're at the peak of the cycle and about to go into a down cycle. Typically, we kind of overbuild into the cycles, and then the supply peaks when demand starts to fall off. Thankfully, given COVID-19 and the inflation environment a couple of years ago, we did not see a lot of oversupply in many of the segments of the real estate market. I would say residential apartments, specifically in the Sun Belt, did see that in terms of overall oversupply, which has been delivering over the last year. It has a little bit more to go this year, but construction starts now over the last 18 months have really fallen off a cliff. Apartment starts are down over 50%. Industrial starts are down 70%. So that, from a forward look, is very positive for both residential and industrial, if demand remains consistent and healthy enough to absorb some of the excess supply that we've had delivered over the last year. So we think about the next year, again, if demand remains consistent, we actually see accelerating fundamentals for the residential side, apartments specifically, and then also industrial, even though you mentioned more in apartments versus industrial.
John, we have an audience member who wants you to put on a turban and do your Karnak thing, for those who are old enough to remember Johnny Carson, because he's asking, which sectors do you project to have the lowest volatility in terms of funds from operations over the next 3 years?
Yeah, thanks for the Karnak reference. I've tried to teach my kids that, maybe your boss won't know who Karnak is, but your boss's boss might. So let's go in the Wayback Machine. I think that part of this is going to really depend on, as I said before, we're sort of trying to figure out what the end game of tariffs are, right? Is this a process to try to ultimately lower trade barriers and effectively have more trade, maybe with the U.S. having more exports and maybe having a closer to balance of import and export? or is this really a policy shift to try to actually reduce the amount of global trade altogether? And I think your perspective on that is really going to color sort of what sectors you're looking at. So, if we just think about, if we just look at returns as a little bit of a precursor, maybe of longer term earnings, we could see that industrial, was as of March 31st was up 6.1%, having a nice recovery from tough returns in 2024, driven by the supply demand conditions Kristin was just talking through, and now has dropped by nearly 15% in the month of April, reflecting so that's where you're going to really see that kind of trade induced volatility. Again, if you have flow through into a recession, then you start hitting things like retail, residential, maybe self storage. And as Kristin mentioned, one of the things we've seen is that certainly markets have been suggesting those pockets of resilience are actually a little bit more in the tech-oriented sectors. So, the best performing sector in REIT land so far in April has been telecommunications, cell phone towers, data centers are second best. So those are places where you might see sort of trade resilient demand. And certainly, sort of I think, cell phone usage, data usage, that now is no longer goes into consumer discretionary. That's a need to have.
Kristin, one of our attendees is observing that, there's early indications that international travelers are reconsidering coming to the United States. I know that travel from Canada to the United States is way down for a very clear reason.
Yes.
Would that, his question is, would that affect primarily hospitality markets, the big hospitality markets meaningfully, with little impact on secondary and tertiary markets, or would it have a more general effect than that, really kind of extending beyond just the big gateway and tourism markets?
Obviously, the tourism markets, the big gateway markets would feel it first, as that's where most of the international tourists come to first. I would think that there would be nothing that would be unimpacted. Obviously, the coasts have more of the resort markets and such, so they're going to feel an immediate impact. The strong dollar hasn't helped also over the last couple of years of having the international tourists come to the U.S. We've seen a lot of domestic travelers going outside given the strong dollar. So it's a confluence of events of negativity around the U.S., the strong dollar, which is I think obviously impacting the international tourists to come to the U.S. these days.
Mm-hmm. So, John, what about the investor? And we have one in our audience who's thinking in terms of how about a segment that if I allocate to, I can defend against volatility in 2025 in terms of performance and yield. Is there a segment that you would say, hey, this is one that looks solid and will have minimum volatility during 2025? Go ahead and walk that plank, John.
Yeah. So,
Yeah, John, you're going to take that one, not me.
I was going to say, I thought I saw Kristin raise her hand. I think this is, again, I really think this in some ways, it goes back to what I was talking about is, trying to determine what policy regime we're in. I think is really important. And I would say, I think we'll probably learn a lot about that, if not over the next 24 hours, over the next week, or over the next month. And we'll see whether we see a series of deals being announced where tariffs are delayed, put on hold. I think that the U.S., Mexico, Canada example I think is kind of interesting in the sense that we had a lot of bluster, we had a lot of things go back and forth, but ultimately what we've seen is that outside of autos, and that's a big outside, but most of the sort of NAFTA, USMCA agreements are still in force for the products covered by those. So the reality of what's happened with the U.S. and Mexico, leaving aside autos again, which is a big asterisk, but for a lot of products, they've been basically unaffected, despite the fact that we had highs, lows, a lot of soap opera. That said, I think what markets are telling us is that the two sectors, markets are telling us over the last week they think are the most resilient are telecom, data centers, actually followed by gaming, which may be a little bit, if people are going to, pull back on some of their entertainment expenses, maybe not take the trip to may not take the big vacation. Maybe we see more gaming demand, and then healthcare has also outperformed the broader market. Healthcare came in as the second best performing sector on a year-to-date basis, had a great 2024, fantastic supply demand conditions, especially in senior housing, and has been, it's taken its lumps here over the last week, but has outperformed the broader REIT market and has significantly outperformed broader equities.
Yeah, if things are a little tight, everybody thinks, why not go gamble? Everybody thinks they're going to win. Bankruptcy court is full of people who think that way. But yeah, even good times and bad, people like to gamble, especially when there's great sporting tournaments going on, like March Madness, which just ended last night. Um, Let me ask you, Kristin, this is again from an audience member asking about whether the United States currently has enough lumber, drywall, rebar, and so on to continue to build new apartments, and whether the tariffs will wipe out enough of the returns, which in turn would cause building starts to continue to stall. I hate to piggyback on somebody else's question, Kristin, but I'm going to do it anyway. We have a housing crisis in this country. Is this going to exacerbate it? I mean, if you could answer that question, but stick with the question, and I'm happy to repeat it since I threw so many words at you, if you wanted to hear that one again. But are we facing an exacerbation of the housing crisis based on what, at least in part, on what this questioner is talking about?
In my personal opinion, Mike, yes. I think, housing has been unaffordable for a very long time. We have a shortage of housing going back over the last decade. We've underinvested across the country, partially because it's the material costs and labor costs continue to increase. If we add tariffs on that from a lumber perspective, we get a lot of lumber in from Canada. That will make the problem worse. And I think also, if you look at just the overall, development cost for construction, apartments especially, there's estimates out there that rents have to rise between 20 and 50% to make it acceptable development return. So think about what the developer wants to earn from that development. They need about 20 to 50% higher rents to do so, given what costs are today to develop that asset. So we do think that housing will remain in short supply. And then also the question becomes, what happens with interest rates? There's a locked-in effect today with the renter pool that it is a lot cheaper to rent today, a single family rental or an apartment versus buying. So the supply of housing sales has been very low. Does that change over time? And how do we get to have that demand for buying a house come back? And how do we meet that demand? Is there more supply in the marketplace today from new housing? Does existing homeowners finally sell their homes because they're locked in, given their in-place mortgages? So I do think that we are in a place where actually making the housing crisis worse if we put tariffs on from a construction perspective.
Mm-hmm. John Worth, we've got another question regarding real estate equity versus debt. What's your opinion regarding equity versus debt? Are we seeing negative leverage impacting deal leverage ratios? And I will say, obviously, debt's been really hot lately, John. So what do you think about that question?
Yeah, I mean, I think it really depends on kind of the risk return profile you're looking for. We've got REITs in the U.S. have about $600 billion in investment grade unsecured REIT level debt. That's been one of the key ways they've been able to actually access capital, even as the bank channel has been tougher to access. That bank channel's easing up a bit, but still coming at a premium in terms of rates. So one of the things we've definitely seen, just when we look at who attends our large investor conference, REIT Week, we see every year more fixed income investors coming in. We actually have now a room dedicated to fixed income investors, and because people are realizing they can get a form of real estate returns, obviously with much less volatility because it's a debt instrument, with a lot of security around it because obviously, you're much higher up in the capital stack, and you've got some pretty significant sort of structures of the deal that give you a lot of security. So, I think we're definitely seeing, more exposure growing to real estate debt generally. We're seeing more holders of REIT debt. It really depends, though, on kind of that risk return profile you're looking for. I think, it's not going to generate the equity-like returns, but it is going to come with much lower, volatility and less downside risk.
Kristin Kuney, what about, oh, did you want to add to that, Kristin?
I would just add back to what John was also saying earlier about the public and private differential. You think about just the public market having that access to the unsecured debt market, which the private companies do not. So we have that additional sourcing of financing available to the public markets, and obviously at much lower leverage levels than the private market. So again, just that complexity of the differences between the public and the private market, which again, maybe we're a little bit biased, but we have I think the public market's in a much better state than the private markets from a leverage standpoint and access to capital.
So, Kristin, I'm going to stick with you on cold storage. You remember how hot it was during COVID? They said, we need to transport food, we need to transport medicines, and so on. We have an audience member saying, what is the outlook on cold storage given recent developments with, well, how big that plays on it, but what do you see as the outlook for cold storage?
Sorry, Mike, you broke up there a little bit. You froze. Can you repeat any part of that question?
Oh, yeah. I was just asking, or our audience members asking, what is your outlook on cold storage?
We do think that, throughput has been low and inventories are low though too. We do think that at some point in time, we're going to have a recovery in terms of volumes. Individuals will continue to eat and come back to both eating at the overall level of consumption that they had in the past. It's been relatively resilient. What's been good about the cold storage companies, they've taken a lot of costs out of the system versus where they were in pre-COVID. So even though throughput and inventories have been low, margins have actually been up. So we think once throughput comes back, there'll be a nice operating leverage in terms of just the overall NOI growth that the sector will put up.
Hey, John.
Mike, I just want to add one thing to cold storage because I think I'm like a cold storage fanboy. I think it's just a fascinating business. And one of the really fascinating things about it that I think is such a great example of kind of where I think commercial real estate is trending is this notion that you really need to do it as a network. So one cold storage facility, it's okay, but the clients you're serving, your tenants, they need you to come bring a network solution. And so you really have to have scale, which I think is, we've talked before. I think when we look back over 10 years and when we look back, we're going to see that one of the dominant themes of real estate is scale, that you bring the operating platform, that you bring the network, because it's so critical to actually serve your clients' needs. And cold storage is a perfect example.
Mm-hmm, mm-hmm. John, what about manufactured housing? There's a question here saying, is manufactured housing the most defensive sector now? I noticed Greystar made a big announcement months ago saying they're going to, for their housing developments, or they're going to factory-built modular housing. I don't know if that plays into your answer for this one, but a point of interest.
Yeah, well, I think manufactured housing. So there's two components, right? When we talk about manufactured housing, we tend to think about manufactured housing communities where the tenants are really renting essentially a concrete pad in a community, bringing their manufactured home or purchasing a manufactured home, bring it to that community. That has been a great story, I think, in terms of both delivering affordable housing solutions, both to people during their working lives, but also during retirement and phasing in and out of retirement, and a ability to get access to housing at an affordable price point. I think the question might be more about in terms of developing new single family and single family for rent communities, more of that hybrid style construction where you're seeing part of the construction done in a factory, brought to the site, assembled there. that has been, I think, in some ways, a bit of a holy grail in terms of single family home building, and something that I think, as I understand it, there have been some real improvements in the ability to do that and deliver a really high quality product that looks like a class, a first class home that was built by a local home builder. So I think that manufactured housing definitely be a nice defensive sector. I think there's no doubt about it. The real issue there has been the ability to grow supply. It's really been supply constrained. Communities, I think there's actually a little bit of stigma around the whole concept. Communities are very reluctant to allow new construction of manufactured home communities. It's a real shame. It's a great housing source, but that has really benefited the incumbent owners.
Uh-huh. Hey, we have an audience member who got in late and says, could you please send a recording of the webinar? Yes. What you missed at the top is that the webinar will be sent out to everybody who registered. It will also be on the Real Assets Advisor website, as well as the the IREI, Institutional Real Estate Incorporated website. So you can see it in its entirety. Now, I've been the questions from the audience have been coming fast and furious, but I do want to ask you, John, to talk about re-earnings season during the first quarter that wrapped up in the first quarter wrapped up 2024. So, what did full year 2024 results tell us in terms of balance sheets, capital raising, and so forth?
Yeah, and yeah, Mike, I'll keep it quick because I see these questions flowing in left and right, and we put out something called the T Tracker, the REIT total industry tracker each quarter, and it's a way you could keep your finger on the pulse of what's going on in terms of REIT operational performance, which we have seen some divergence between operational strength and sort of an equity performance. So it was actually ended up being a strong year for REITs. We saw that fourth quarter FFO was actually actually a record high in terms of total FFO at close to 21.21 billion, nearly 21 billion. That was up over 11% from a year prior. Q4 NOI was also in the fourth quarter was also 5.5% higher than a year prior. Occupancy rates remained high. We had occupancy rates well above 90% in retail, apartments, and industrial. Office came in around 86%. And so, but the declines seem to have stopped, and that sort of flatlined, and even started seeing some improvement in some markets. And then I think as Kristin mentioned before, when you look at REITs and areas of strength, it's really the balance sheets that continue to stand out. We've got leverage ratios around 32%. So REITs have carrying very low leverage. Most of that debt that they're holding is fixed rate debt. Most of it is unsecured, so it's actually been issued in the corporate debt markets. That's over 80%. And we've got a nice term of the debt. Today, we see a weighted average term to maturity of nearly 6.5 years. So REITs really, as it seems, we are through rates rising, but maybe into a period of longer for longer, and into what we consider a longer period of higher interest rates. We feel like REITs are really well positioned to navigate that.
Kristin, here's an interesting and interstellar question for you. Do you see low orbit satellites such as Starlink? And I know that Jeff Bezos in Blue Origin is also putting up a system similar to that. Do you see these low orbit satellites as a significant risk to cell towers?
I would think, we believe that they're complementary to cell towers. If you look at just the ability to, go across large areas and covered large areas from a, coverage standpoint, the satellites do not work well. Really, the towers are the ones that give you the very long coverage over a very wide span of the Earth, where the satellites are very good for very distinct areas. They don't hand off. If you're a moving object, like in a car, the cell phone towers can kind of as you go along, hand off the data to the next tower, where you have distinct satellites are not able to move, do not follow the movement of you very well. So we think that they work very well in rural areas where it's very difficult to put in new cell phone tower coverage, but they will not replace towers, we don't believe, but be more complementary in those areas where it's harder to put in coverage from a tower perspective.
Mm-hmm. Kristin, sticking with you, construction starts massively declined. You mentioned that earlier, declined since their peak in late 2022. What effect do you expect this to have on commercial real estate in terms of performance?
Yeah, as we talked.
Doesn't that indicate that, the lack of new starts means sectors won't get overbuilt and the existing stock would seem would
More available. Exactly. So very much as we talked about, Mike, real estate is very much a supply and demand game. So as long as supply remains muted, which we do think continues on, just given the uncertainty and the cost of bringing on new development, that if demand remains consistent or at least healthy enough, that we'll see accelerating fundamentals for existing assets. And what do we mean by that? Is really accelerating rent growth and pricing power for the existing assets. If there's less space for competition, then typically the tenant will remain in the space it is, which will give the owner the ability to increase that rent for that tenant. So we do think that low supply is very good across all different asset types within real estate. And if you think about also just the cost to bring on new construction, that replacement cost keeps going up more with inflation between materials and labor costs. That's inherently good for existing real estate asset values. As replacement costs go up, existing asset values will follow suit.
Mm-hmm. Another timely question here. There is a lot of focus on high property taxes and insurance costs in markets like Texas and Florida. I would add California to that. Do you see that impacting the residential market negatively? Who wants to take that one? That's a jump ball. Who can jump higher? Kristin, you or John?
John can definitely jump higher than I can.
I'll just say, I think, property tax and insurance drag are really important across sectors, across regions. I think, one of the things sometimes people don't understand is that, property taxes alone can account for 40% of operating expenses for a commercial real estate facility. Again, an area that people sometimes don't compute is the incredible drag that property taxes and insurance have on residential home ownership. One of the questions we sometimes get is, I own a house. I've got this big house. It's a big chunk of my assets. Maybe I own a vacation home. Do I need commercial real estate in my portfolio? And an analysis we recently updated was just looking at long-term returns to home ownership and commercial real estate. And what you see is that commercial real estate significantly outperforms home ownership. And one of the reasons I think people don't intuitively see that is because maybe at the end of the year, they don't tally up exactly how much of their home price appreciation has sort of been liquidated through paying their property taxes, paying their insurance, CapEx. I always like to tell people I gave up about 3 years of home price appreciation in a weekend when we decided we should replace our HVAC on a Saturday morning. So those types of things really have a meaningful impact on the economics of real estate across commercial, residential. They're really important.
Mm-hmm. Hey, Kristin, let's have you answer this last question. We're almost out of time. Can you give us an explanation on how one of your clients might integrate public REITs into the real estate sleeve of their portfolio?
Sure.
I'm sure audience members would be curious about how Goldman Sachs client might be regarded and utilize public REITs. What's the strategy there?
Sure. I think the question first is, do they have exposure to commercial real estate in the private markets at all? And if so, how can we complement that exposure via the public REIT market? So as we talked about, the complexion of the private REIT market, real estate market is still heavily weighted to office, industrial, retail, and apartments. Or if you look at the public market, that's about 50% of the market. So you have a diversification of sectors in the public market. We have exposure to cell phone towers that we talked about. You can't access in the private market. You have data centers, which you really can't access very well in the private market. single family rental, storage. So that diversification that you get from the public market gives you access to a lot of the secular growth trends that we see over time. So senior housing is another good example. You can't really access that very well in the private markets. Very strong fundamental demand over the next couple of years, very low supply. We think that's a very interesting area. The market's done well, but continue to see very strong fundamental aspects of that sector. So we think that depends on if you have private exposure, you would want to complement it with a completion strategy, as we call it, and really kind of access those sectors you cannot access in the private market via the public market. If they do not have private exposure, I would think about more of a broader REIT allocation. And then also the third option that have become a little bit more interesting over the last couple of years, interval funds, which really blends public and private under one 40 Act registered mutual fund, which actually gives access to all investors, which maybe not have access to public, private commercial real estate in other markets.
Kristin Kuney of Goldman Sachs Asset Management, John Worth of Nareit, thank you for sharing your data and insights. And to our audience members, we thank you for your attendance and participation. Lots of questions from you. We really appreciate that you're so active with us. Please be apprised that our next REIT webinar is scheduled for July 15th. Keep an eye out for the publicity and registration information for that one. We hope to see you there. On behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you all a good day and a great second quarter of 2025.
Thanks, Mike. Thanks, everyone.